first topic I want to bring up, Gabe, is a little bit of a blurred line, you might say. And I want to talk about the line between risky and reckless.
Yeah.
These are two words that you might, maybe if you're not in the risk-taking business or you're not thinking about this all the time, these might sound pretty similar to you, but to me, they're totally different. What comes to mind when I bring up that line between risky and reckless? What immediately occurs to you?
To me, it's pretty clear that in one, you know the odds, and then the other one, you don't know the odds of success or failure. Because you could definitely make a bet. If you know the odds, you know what you can risk. You know what the outcomes are. You know what potentially, if the outcomes are negative, what the effect is on your, let's say, portfolio or on your life is. And the other one, I think it's complete disregard for that knowledge that may put you in a very bad spot. In some parts, it's no different than gambling, right? The reckless part. In fact, I would say gambling is a little bit more safe because you know the odds and you know that you're not going to bet the house on something. So that's my point of view here. And there's examples of this in the market all the time when people make these decisions. But
give us a market example of what you think is risky decision making and risk taking versus recklessness.
So to me, GameStop was a pretty clear example. I think a risky proposition would have been, buying it, from 4 to maybe 15 or 20, where there is value there, but anything above it potentially could be reckless. Obviously, there's extreme, I would say, extreme understanding of the company and the situation where people think that the opportunity is there, and so they will take a higher risk. But there's a point where that threshold crosses to recklessness. And I think, any price above 200 to me was evident of recklessness. But another historical example is like the tulip mania. Like who will bet, who will buy flowers like for crazy prices? That's just not smart.
That's interesting that you took kind of a value fundamentals approach to that line between risky and reckless. Like you can make a case on a fundamental level at certain prices for this company's equity. You said between 4 and 15 or whatever. And then above that, like pure speculation comes in. That's interesting because I think that there's probably funds where, or market participants where they're scalping in some way and taking calculated risks with the trading between 200 and 350. But I don't think most retail traders, for example, were in it for that, right? I think they were probably in the reckless camp. When I think about this, I think about the range of outcomes, similar to how you talked about whether we know the range of outcomes at all. I think when the range of outcomes includes catastrophic wipeout, and that can be applied in so many different ways, that flows into recklessness for me.
Yeah.
But this line really is blurry. Like, for instance, there's certain cases where starting a business is like pretty close to a reckless proposition, right? The chance of total wealth wipeout, of derailing what would have otherwise been a successful career, that can seem reckless, but then in hindsight, it looks great, right? There's probably reckless choices that get made within fast-growing startups, right? Or are those always risky, not reckless?
I would say, there is a potential for, the outcomes. I would say, like, if you're able to do a probability, like the expected value. So it's like 15% a success and you get an outcome of $400. And then you have an 85% success with an outcome of 0. And, you sum that up, it's 400. If you're betting $300 on that, then it makes sense, right? It can be
positive expected value.
Positive expected value. Now, if you tell me like, oh, I have 1% and I'm going to make like millions, yeah, you still have a positive expected value, but the probability is so low that, to me, it is like sometimes even with a positive expected value, you might still have a reckless decision because the probabilities of success are so low. They're not really high. It's for me that's like it's similar to maybe the lottery, right? You're playing the
Yeah.
lottery, but the difference I think between reckless and risky here is the amount that you put in, right? When you buy a lottery ticket, you're not putting your entire like nest egg there,
Right.
right?
Right.
So I think that is the main difference, right? Like you can have a positive expected value and everything, but at the end of the day, it means also how much money you end up putting down. Can you start again? Can you recover from that? Um, and I think that's the difference between risky and reckless.
I like that a lot. I'll make a shout out here. The reason I thought of this topic was because I got served a video on YouTube by Casey Neistat, I think is his name. He made a video about this exact topic, and he talked about climbing the biggest mountain in the southern hemisphere with his buddy. He's like in his mid 20s.
Is that Kilimanjaro?
No, there's a higher one in the Chilean Alps.
Oh, okay.
And it was post. He had already done Kilimanjaro, and they were like, "No, we need to go for something bigger." And they went to Chile completely unprepared and ascended above 20,000 feet. At which point, altitude, like basically, you're on Mars. Like you're not. Your brain doesn't work right. Nothing works.
I think there's a time limit how much time you can spend at that level.
Oh yeah. And they had no backup plan. They didn't have satellite phones. It was like he admitted recklessness, right? So I thought that was an interesting. That made me think of it like, okay, some of this is quantifiable. Some of this applies to our financial lives.
Another topic here, which is margin. I don't know if you've seen the charts of like the amount of margin that's being used in the market.
Brokerage market margin.
That's being pretty much the graph is like almost like perpendicular to time. There's another problem, right? Right now, maybe you might be taking a risky position, but the sum of all those risky positions might end up being reckless.
Interesting. There's the other side of that was in the financial crisis. Of course, this was all fake, but they added up a bunch of risky propositions, which was all these mortgage loans, packaged them all together and said, oh, it's diversified because it's all these different risky propositions packaged into one thing.
It's an amazing example, actually, of how small, risky propositions end up being reckless.
Of the two of us, Gabe, I think it's fair to say that I play around in the crypto space a little bit more than you do. There's this corner of the crypto world that I want to just propose to you and kind of poke around. For the audience, we haven't talked about this at all, so this is a live set of feedback that I'm getting from Gabe here. There's a company, a well-capitalized venture-backed company called BlockFi. I think they're based in New York. I don't know. And BlockFi will let you deposit what are functionally dollars. They're called stablecoins. We can get to what that is and why that exists. But it lets you deposit dollars in an account at BlockFi. It doesn't feel all that different from opening an online bank account. It's pretty similar. They do KYC stuff and you have this account. And at present, as of mid-February 2021, they will pay you 8.5% yield annualized, paid out monthly, on your stable coins, which are, again, functionally dollars, in that account. Now, 8.5% seems preposterously high, very, very high, for what seems like a savings account, right? Like a liquid account. If you can't get a dividend that high, savings accounts pay you 0.4% at present.
Like that.
So I want to get your take on this. I know I just gave you the barest of explanations, but what do you think? What questions do you have about this proposition thus far?
What is the risk entailed with this?
The first thing to understand is that this is neither SIPC nor FDIC insured. And this is not a savings account.
Is it backed? Is it collateralized? How do you get the money?
Yes. So there's a couple layers of abstraction. It's arguably collateralized, but you don't have, in my opinion, from what I've seen, you don't have quite the level of transparency into the collateralization that you would have, nor the guarantee of an FDIC insured account. So there are paper There are promises that it's collateralized and promises of prudent use of capital. But in reality, what's happening is that this company, in this case BlockFi, is using your funds to lend out in the marketplace. And they're lending out to some well-capitalized, credit-worthy lenders, and probably some that are less well-capitalized and less credit-worthy.
But so how is this different from just, putting money into a BDC, a business development company, getting a, 8.5% yield, dividend yield?
The first layer of abstraction that's worth knowing about is the stablecoin thing. Stablecoins are a weird corner of the world. They are dollar-backed cryptocurrencies that are meant to always be worth $1. So they're stable. They're meant to be worth $1 all the time. The best of them have top-tier auditing firms that will attest every month that say, yes, this company actually has this many dollars in the bank and this many coins outstanding, therefore it's dollar-backed, right? Not that complicated. You hire an auditor to say, I've got the money, right?
Yeah.
And mostly the market has trusted them. There's examples of issues out there for sure. But nonetheless, there's a few of them that have so far very good reputations. So first thing you have to do is change actual US dollars in a bank account to this stablecoin regime, and you have to trust the stablecoin regime, right? You have to trust the auditors. So that's one thing that you don't have to do with a business development company.
Yeah, because you just invest your dollars, right? So, and you
Right.
open a brokerage account, you put dollars in, and you buy the stock.
That's right. That's right. The other thing is that a business development company is probably going to have a specific mandate around who they're lending to, terms, and they're going to publish a lot more about the portfolio of loans that they're creating. Like in a BDC, you can go read the SEC filings and say, we're loaning X dollars out. It's on these terms. Here's why we think our borrowers are credit worthy. Here's the warrants that we have in case the companies do great, yada, yada. You get a lot of information. At a place like BlockFi, you're not getting this on whoever they're lending to out in the marketplace. You just don't have that knowledge. You have some anecdotes. So like the chief risk officer, the reason I brought this up is I listened to him on a podcast that just came out yesterday, and he mentioned Virtue, which is a publicly traded firm, right? They're doing business with Virtue. They're lending stablecoin deposits and Bitcoin deposits from BlockFi to Virtue. So that's a compelling proposition, right? That's a credit-worthy company, publicly traded. You can go read their financials. So in that way, it's similar to a BDC. But the rest of the lending book, I would say, is not so similar.
So, but are you lending it to BlockFi? You're not really lending it to BlockFi. You're lending it directly to a company through BlockFi.
No, you're just on the BlockFi platform. BlockFi is charging a higher interest rate to whoever they're lending it to, and they're paying you a pass-through of 8.5%. So they're definitely earning a spread on whatever's going on out there.
Got it. Someone who's been in this business, if there's no disclosures of like where my money is going, I would be like very careful.
I would urge care as well here. Here's the thing about the low interest rate environment. This is like a basic test of financial literacy. If someone says, I'm going to give you an 8.5% return and there's no risk, are they lying? Yes, they're lying. There is absolutely risk. There are massive bodies of money, institutions who would die at the chance to earn an 8.5% return with no risk. If there were no risk involved, it would be arbitraged away just because interest rates are pegged so low and markets are so competitive. I think March 15th or 16th of last year, Bitcoin lost like 55% a day. So that's an Armageddon scenario for a company like that has money out on margin to trading firms, right? Who are trying to trade Bitcoin and stuff. And they survived. The system didn't blow up. So that is some sort of testament, but it's young. It's largely unproven. Tread with caution.
I have a question for you. With the crypto, do you have any? Do you own any Bitcoins, Ethereum, or any other coins?
Yes, I do. And IRS, yes, I disclosed it on that little checkbox.
Do you think Bitcoin is fairly valued right now?
My philosophy on Bitcoin is that Charles Ponzi himself, the inventor of the Ponzi scheme, could not have come up with a better like bubble creating asset. It has so many characteristics that lend itself to feverish participation and buying. And there's just been a lot of really, really good, like in the past week, it's hard for me to overstate how good the past 10 days have been for the Bitcoin narrative and Bitcoin ecosystem. Like it's better than the last 5 years of news combined.
Yeah.
So I do. It's a pretty big market. So big markets make me tend towards, yes, things are probably fairly valued where they trade. And it's a pretty big market with pretty big players in it. So
My impression is that you have this latest, I would say, I don't know, 6 months maybe, a little bit, even less. You have maybe last month, you have a ton of institutional interest in it. And there's already like big fish, I think, starting to buy up Bitcoin. There's already infrastructure of wallets. We might see, companies in the Bitcoin space that provide services to the Bitcoin space going public. I think this environment, this ecosystem, will just continue to grow, and the price of Bitcoin, the higher price of Bitcoin, is just a virtuous cycle. Like it expands the entire ecosystem, and at the end, it might be just a self-fulfilling prophecy where the price reaches new astonishing highs. With gold, it's much easier because you understand supply and demand. Here, supply is pretty quick to understand. Like there's a limited supply, and this is it. On the demand aspect, I have much bigger questions because I don't know what the demand will be in the future. The one thing I do know is that the Bitcoin infrastructure for payments is actually pretty weak. It's not meant to be used for transactions.
do you think Facebook has a fair value attached to its stock price?
Yeah, because it has advertising earnings to that network, right? There's a use for on the platform. I think in Bitcoin, at least, the cost of mining is the cost of the floor, right? But it's so low compared to what the price is now. The direct correlation to like the delta between the mining price and the current price, you'll see it definitely in chips, right? There's going to be a surge in demand for anything that has to do with mining.
There already is the top mining. They're called ASIC, application specific integrated circuits, that are they're computers that all they can do is mine Bitcoin. The secondary market for them is on fire. You cannot get the top miners for anything less than 3-4 times the manufacturer's cost.
Who manufactures the chips that go in? Is it NVIDIA?
No, I don't think they do ASIC. I think it's all specialty players, mostly in China.
The next topic, SPACs, and the I would say ISOs on companies that the SPACs are buying.
Yes.
So incentive stock options. If you have options in a company that is either merging with a SPAC or being acquired by some other company, also this is a valid topic, right? SPAC is it's short for Special Purpose Acquisition Vehicle. So it's essentially a shell company that is essentially, in other words, a fund where it issues shares, gets money, and is out there looking in the market for deals likely to bring a private company to the market. And how do they do it? They merge into the SPAC, and that's essentially they avoid the entire IPO process. It's a quick win. There's a couple of issues doing so. I would say there's a lot of dilution going on, but there's also dilution in IPOing at a low price. I would say it's just a symptom of the markets right now. The markets are very hot. SPACs are in vogue again, and as a result, you see a lot of these coming to play. There's a ton of interesting fund managers that have raised SPACs. There's also some famous people that have nothing to do in the markets that have raised funds just because of their name. I guess they give gathered attention. But typically it is The typical profile of a SPAC fund manager is someone who's been successful in a specific type of industry, has a lot of experience, has a lot of contacts, and can open doors very easily. And those people at the end of their career decide to launch a SPAC, where they look for a company and then they take a huge chunk of that, the combined company between the company and the SPAC. They take a big portion of the I would say of ownership in that company, and they hopefully the market will recognize the value of the company, and the SPAC will go up in value. The biggest problem that I see what people do is that they invest in these SPACs after there's rumors of an acquisition, and then that acquisition doesn't happen, and so the SPAC trades up in value on the rumor, and then new information comes out that the deal is not happening, and it falls in value. Usually, if it falls below $10, so SPACs are issued at $10 a share. If it falls below that, you can, at the end of the SPAC has 1 year to fulfill its original mission of finding a company. If it doesn't fulfill that in 1 year, they should return the money to shareholders, at the cost of whatever the shares were.
In the example that we're talking about ISOs, incentive stock options. We won't go through all of what that means, but basically it means part of your compensation, if you're an employee of a private company, is through stock options. And one key thing about stock options is that as they vest, meaning become available to you, you have the option, you have the right, but not the need, not the obligation to exercise those shares. So in a scenario, Gabe, let's say someone had 10,000 shares granted to them as incentive stock options, and they get a notification on Monday morning, and they hadn't exercised any of them. They get a notification on Monday morning that their private company employer is announcing a deal via a SPAC. Should they have exercised their stock options before that? Does this affect anything?
Depends what the fair market value of, I would say, the stock is going to end up trading at. But usually it's the case where the internal fair market value of the company is pretty low compared to where the market is trading. That's what's happening now. And so for someone who hasn't exercised yet, exercising at a much higher fair market value is going to be very costly in terms of taxes. They're likely going to have to pay AMT taxes because the exercise of incentive stock options, where the difference between the strike price of the option that they were given and the fair market value of the company is large, that's considered something that's called bargain element. And the bargain element is it's an add back when you're calculating AMT taxes. So essentially, that amount has to be added to the calculation of AMT taxes, and then you're paying typically at the end of the day, whatever the AMT taxable income is, you pay either 26 or 28%, I believe, on that. If that amount is greater than your regular taxes, then welcome to the AMT.
So the other piece here that's really important is vesting. So let's say you started at the company 2 years ago, and you got a block of ISOs. You got those 10,000 shares, and only half of them have vested so far. So only 5,000 of your ISOs have vested. There's an important possibility in this SPAC transaction with your shares, and this is around accelerated vesting.
Yeah, when I hear, like, when someone calls me up and says, "Hey, I think we're going to merge with a SPAC, or we're being acquired," I'm like, give me the grant documents immediately. Like, just find them. Go through your chest in your house where you put all the documents.
Right. Scan them, send them ASAP.
So scan them, look for any sort of language about accelerated vesting And
Changing control.
changing control. That's like the search. Control F, changing control.
That's right. That's right.
If you see that word in there, usually it's a good sign. If you don't see the word in there, usually it's not a bad sign. It is what it is.
Right. I wanted to ask you maybe before we get into like trying to interpret the change of control part of your documents, which is going to be written in legalese by lawyers, by the way. What's kind of the base case here for someone with ISOs that have not yet vested and a SPAC announcement is made? What's the base case, maybe most likely, most common scenario for those ISO holders?
Personally, right now, I see no change of control conditions in there. I think it's only like founders who are very nice to their employees will put the change of control provision in there. And what this means is that, yeah, you're not going to get accelerated vesting. And accelerated vesting means that all your shares that you had been granted become exercisable, at a specific date, whatever it is.
Right, upon change of control, meaning a merger, an acquisition, whatever it is, or going public. Right, so your base case that you should probably assume is that if you have unvested shares and you're going through a SPAC, the likely scenario is that you're not getting all those shares that you still have 2 more years of clock on, unless your management team or your board of directors are like awesome negotiators. You're probably not getting those quicker. And that brings up a broader point, which is that when these deals happen, you as a shareholder, right, if you have exercised your ISOs, you're now a shareholder of the private company. You're beholden to the negotiating skills of your management in these transactions, right? There's a bunch of moving parts, and how good of a job they do for you, the board of directors, more specifically than the management. The board works for the shareholders, right? You're beholden to how good of a job they do negotiating with the SPAC sponsor or whoever it is that's doing the merger acquisition.
Yeah, unfortunately, what ends up happening a lot is that whoever, when they merge into there's a new compensation package to management. And unless you are in that upper echelon of management, you don't see much of a difference. The fortunate part is that if you are in that upper echelon of management, you will definitely get a new compensation package, probably a very nice one. The key thing here is that when these things happen, these announcements usually come with rumors attached before. If you're able to, if you have visibility, I would say, an understanding of where your company is heading, and you literally think that the company either will, if they don't merge, they will go public in a couple of years because management has indicated that they want it. It's their intention. You might want to consider exercising as much as you can before this, because what's happening is that you want to minimize the delta, the difference between the 409A valuation and the strike price, so that your outlay in tax time is smaller. When you exercise those options, you should be able to get a statement of what the 409 valuation was when you exercised. A lot of these private companies are actually traded in private market exchanges. And so there is some price discovery going on there. If the 409 valuation is substantially below the private market valuation, you will see a rise in the 409 valuation every couple of weeks or months or whatever. So if that's the case, if you have indications of what the private market is valuing the company, then it might be in your interest to exercise as much as possible. Again, you have to talk to a financial advisor that can review your specific situation and make sure you're not making a reckless decision.
Our special viewer who wrote in with the ISO questions about the SPAC, the answer was basically not a huge change in your ISO outlook. There was no accelerated vesting in this case. The shares that he had already exercised are going to be merged and converted with the SPAC per the rest of the other shareholders, and the future ones were not necessarily laid out. It wasn't laid out clearly in his grant documents. So he didn't have a ton of clarity as to that. So he had to wait for the the big HR meeting right after the announcement and wait for everyone to ask questions about, hey, do we get accelerated vesting? Hey, how many shares? What's the conversion rate of shares in our company to shares in the new company, right? So much of it is going to be very, very deal specific. And that just goes back to the point around board of directors and management negotiating on your behalf. You're a shareholder now, right? That's part of the equity compensation game.
The one thing I will say, though, usually after these mergers happen, there is a compensation review across the board in the company, and people will be able to get maybe another package of shares coming in. There's a revalue of the company, so that just happens. What's your, I would say, base case strategy for RSUs? I would say mine is usually when they vest, I just say sell, especially if you have more RSUs coming in, because they're already being taxed when they vest. So if you're aiming for diversification here, why not just sell and invest on something else?
That's right. That's right. An RSU grant that you get that's net of income tax already. And most of the time the company is withholding some shares to pay payroll tax and pay income tax for you, right? So if you get granted 100 shares, most of the time at most public companies, they're going to sell 30 of them and go pay taxes on it, right? Or 40. Yes, I'm with you completely. Generally, the base case best thing to do is to sell right away and then go diversify. You just immediately gain a diversification benefit that you didn't have before, because mechanically, an RSU grant that's net of taxes is just like a bonus that you use to then buy shares in your company. So selling them is like turning that bonus into cash. Rebuying diversified portfolio is just like swapping that cash for a diversified portfolio. So if you look at the two options of one is hold, and then the second one is diversify, statistically, the diversified one just has a huge leg up on single company stock risk.
That's my statement for today.
I love it. Well, hope those ears stay warm over there. Hope the gas keeps pumping and you guys don't freeze over there. If you need a break, I do have a casita at my house in Arizona. It is in the 70s and sunny today, so just in case.
Does it ever snow in Arizona?
It snows in northern and northeastern Arizona in the mountains, but in Phoenix, no, not really. We're in the middle of the Sonoran Desert, man. It's not a snow place.
Good. All right. Great speaking with you. See you next week.
Likewise. Adios.